Okay, scusate. Thank you for being here, and thank to the Florence School of Banking and Finance who's hosting, and to the CESIFIN who's hosting us today. It's a great pleasure and honor to host this lecture by Dr. Elke König, who doesn't need an introduction, but I will say something about her the last part of my short introductory remarks. I will divide my introduction in three parts. What was before, what do we have now, and what is next in the future, and I guess Dr. König will focus especially on this last part. It's well known that before the introduction of the single resolution mechanism and all the rules that are implied in this mechanism, there was an implicit public guarantee on liabilities of banks. This had perverse consequences that spread on many aspects. First, banks were not sufficiently incentivized to plan for crisis because they knew they were rescued by the state if necessary. There was an implicit subsidy to the banking industry which was not paying adequately for the cost of its funding. There was moral hazard, excessive risks taken by the banks in the assumption that profits were private and losses were public. There was a vicious circle between sovereign debt and the banking system. And a weak banking system can cripple public finances, and unsustainable public debt, in turn, can cripple banks. Ireland is a good example of the first case, and Greece is a good example of the second case. And this has consequences on the functioning of the internal common market, because strong states allow banks to finance at a lower cost, inducing or reinforcing the fragmentation of the common system. The cost of the public aid during the financial crisis have been immense. Many states have paid significant chunks of their GDP as aids for their banks, and although some part of those aids have been recovered, some of them have not, and this has amounted to subsidies to shareholders and creditors of the banks that were failing or likely to fail. This has sparked a transition from bailout to bailin. Banks should be able to fail just like any other firm. We know that bankruptcy allocates the costs on investors. If an automobile producer fails in bankruptcy, its investors pay for the crisis. Shareholders first, creditors second under the applicable hierarchy. So the transition from bailout to bail-in, the principle according to which the cost of a failure of a bank has to be borne by investors, is well justified. So the general principle behind bail-in cannot be disputed. What we have now, after 2014, we have now a uniform set of rules for bank crisis, rules that encompass prevention of crisis, which means planning, early intervention by planning by the banks and the authorities, and early intervention by the supervisory authorities, and resolution when liquidation of a bank is not in the public interest, which means that cannot be pursued without harm to the public interest. What is public interest is a big question. So we have now not only a uniform set of rules, but we have also a complex and well-functioning system mechanism in place. A system that is, as we know, is based on the Single Resolution Board based in Brussels, of which Dr. König is the chairperson, and which is able to act swiftly. Let's remember the case of Banco Popular, which in June was resolved in a matter of hours, and unlike what we generally expect, was not resolved during the weekend, but was resolved during the week. That was really a challenge, I have been told. The single resolution mechanism, as I was saying, is based on the single resolution board, which works in coordination with national resolution authorities, which have jurisdiction, so to say, on less significant institutions, but should act in coordination with the single resolution board and according to the general principle of resolution. We have, however, still areas of uncertainty. What is, the first is definition of public interest. What is exactly? Do normal liquidation procedure have an impact on what is public interest? After the Veneto Banca and Banca Popolare di Vicenza cases, which the single resolution board declined to act upon because was not on the public interest, we tend to think that the fact that the single resolution board in its decision mentioned national Italian insolvency procedure as able to achieve the public interest, we tend to think there is a link between national insolvency procedures for banks and the public interest. Other areas of uncertainty are precautionary recapitalization, state aid, valuation, and no creditor worse off. One of the most difficult issues that spark from the Banco Popular case is a litigation by the bondholder and shareholders on the valuation of Banco Popular, a litigation that is going to have consequences on the system as we now know it. However, I believe that the most difficult issue we are facing today is the issue of transition. Transition from bailout to bailin. This is especially thorny issue in countries in which the public guarantee was perceived as particularly strong, like, for instance, Italy, and in some measures, Germany. I have prepared a slide, but I have not the possibility to show you. The slide taken by the ESMA and EBA joint document of a few months ago that shows how in several European countries, in asymmetrical ways, however, the banks' debt securities are held by retail investors. And we know that this has two possible ways to look at. The first is clearly mis-selling. There have been, we know, everyone knows it, there have been cases of mis-selling by Italian banks. I'm talking about this because we are here. Italian banks that have sold subordinate debt as normal debt to retail investors without adequate information. The second is that we have to think that the transition from bailout to bail-in has been very swift. So what used to be perceived as safe securities from one day to another, or let's say from 1 year to another, were no longer so safe. So this is not a legal problem. The European Court of Justice in the König case of July 2016 has ruled that there is no legitimate expectation for retail investors to be bailed out. So they cannot claim compensation because their shares or the bonds have been cancelled because they were not supposed to be bailed out under a legal rule. However, there was an expectation that the system should not allow these consequences to take place. So what we now know, especially from the case of the so-called four banks, quattro banche, that there have been Italian regional banks that have been resolved in November 2015, we know something that everybody knows. Bail-in as a precondition that the bank has a capital structure to which clients do not contribute with equity or bail-inable liabilities. In other words, if the problem is not doing a bail-in, there's always liabilities to be bailed in. It is operating a bank after a bail-in with the same people you have taken away money from. So the transition, we know at the end of transition, the banks will have a capital structure that will not rely on retail investors unless they have been appropriately informed on the risk, but this does not take place in one day. So we know that this capital structure of banks will eventually take place, but it's a matter of time. So what is next? The first challenge is making banks really resolvable. And Dr. König will tell us something about this today. Making banks really resolvable will unavoidably reshape the market. The movement to making banks resolvable couples with the general trend towards increasing own funds, both for significant institutions, systemic institutions, and for non-systemic institutions. So increasing own funds makes failure less likely. On the other hand, when failure occurs, it should not create disruption. But the problem is that the banking business is an increasingly costly and unprofitable business because of many reasons. Fintech, shadow banking, which is eating profits away from banking business. So the situation, the full implementation of the system after bailout has been ruled out is that several banks will be pushed out of the market, being unable to cope with the new requirements. So what's next again? Maybe that there is some role in the transition for deposit guarantee schemes, especially for national small and medium banks. Maybe the decision of 19 March, 3 days ago, 2019, by the General Court on the Tercas case, Italian Tercas case, no state aid is involved if a private deposit guarantee scheme supports a bank, will open new avenues for helping banks to cope with the transition. So it's now time to give the floor to Dr. Elke König. Elke König is the chair of the Single Resolution Board, the body in charge of the functioning of the Single Resolution Mechanism. This means that she is responsible for the management of the organization, the work of the board, the budget, all staff, and the executive and plenary sessions of the board. We know she is extremely well qualified for the job. She was president of the German Federal Financial Supervisory Authority, BaFin, from 2012 until 2015. She has qualified in business administration, has obtained a doctorate in this subject. Dr. König spent many years working for companies in the financial and insurance sector as a consultant, as director and partner of consulting firms, and the director of important financial institutions. So no one, we could say, is better qualified than her in making this hard job. Thank you.
Thank you. And as my team has written down, but I think it's wrong in Tuscany, it says buon pomeriggio. I think here you say buonasera after lunch. So I think we with that, I would stop with my Italian because you would have a lot to laugh, but you would not understand much from my speech in that case. But thank you, Professor Lorenzo Stagalini, for your opening remarks. I had a bit the feeling when just writing down some of the buzzwords you use that it would easily fill the rest of the evening, and it would be a bit sorry for my little speech, but we will definitely, I hope, have the opportunity to talk about that later. Thank you also, Professor Carletti, for inviting me. This university and this beautiful place has been hidden from me for far too long. So just to make that statement. With that, but I would like to go immediately into the discussion, into my little speech, and then try to save as much time for the other discussants and for the discussion afterwards. I will try to put it a bit into context and to explain first a bit this framework of resolvability that guides our work. Then I will move on to the point where we are actually currently, looking at how to implement this framework into practice through the various tools that we have, what are the obstacles to overcome, and I will also consider how are we now currently turning this theory into practice. That means, what does it really mean? What are we working on concretely at SRB? Given that I'm trying to do an assessment of where the SRB is, where we are today on the road to resolvability, or to also introduce the other picture we're always using. This is a journey. And it's a journey with multiple stops. It's not something where you switch on the light and here you are. So, and with that, I think then we have hopefully time for all the very interesting questions you've raised at the very end. Just as a bit of political or perhaps historical context, last year, all speeches I've heard, all speeches I gave, started with 10 years after the failure of Lehman. Now, for some countries, like the one I come from, the financial crisis started already a year earlier, but this was definitely the turning point. I think what we all learned at that point was that liquidity during the crisis, before the crisis, was taken for granted. The markets are always liquid. And financing is always available because you always have a totally rational market. Credit had been flowing, the world economy was growing, there were a lot of signs, but with all the financial engineering, risk was so thinly spread, never ever could it cause the failure of one of the institutions. This was the story till 2007, then came 2008, and I think we got all reminded of something which I read as a quote from Keynes, who had said many years prior, during the first financial crisis, that markets can remain longer irrational than market participants solvent. And I think this holds true. So what we saw were that extraordinary events, or I think the basic build-up was not extraordinary events, but in the end what it meant was that the events in the financial industry meant that ordinary people through their governments were left to foot the bill for banks and institutions deemed too big to fail. And I'm always saying, don't read too big very literal. It's not just too big in size, it's too interconnected, too complex, to what have you. The effects of mismanagement in the financial industry, well, and light touch regulation, I think we shouldn't take out the sense that we were coming out of a period where good regulation was one that you had dissolved, not one that you had put in place, led to recession, rising unemployment, and quite enormous bills for the taxpayer. You mentioned it. Even nowadays, 11 years on, the European response as part of to all of this is still not fully complete. The European response is the banking union. I think we have come a very long way. We have now the single supervisory mechanism in Frankfurt under the roof of the ECB. We have the single resolution board, but there is a third pillar which was foreseen, which was called the European Deposit Insurance System, which is not yet in place. So not yet complete, but a long way that we have already come. When talking about our business, I think it's always important, and this is more to the students here, there are one directive, one regulation, which are to be learned by heart. It's the Bank Recovery and Resolution Directive, which frames basically the European framework for bank recovery, that's for the supervisor, because it's going concern, and bank resolution. And the second one is the Single Resolution Mechanism regulation, which has put in place the Single Resolution Board in Brussels as the European Banking Union authority, banking union, and all states that want to join, authority for resolution, and that works in very close cooperation, I'm seeing Banca Italia here, with the national resolution authorities in the member states, and I'll come to this, why this is indispensable a bit later. Resolvability, the political policy framework. I think that the crisis, and you mentioned it already, had shown, among others, that we had a lack of tools to effectively wind down or resolve a bank and at the same time minimize the negative repercussions on the public funds and to the broader economy by preserving those functions of the bank that are critical for the economy. What we saw during the crisis is easily explained. Banks had too little capital, and what was counting as capital was not loss absorbing when it came to a crisis, or it was not loss absorbing without causing even larger repercussions. So this is why this framework was put in place, and you said already critical is in the eye of the beholder. I would say not entirely. Broadly, critical functions can be said to be the ones that are essential for the proper functioning of the economy. So we can talk about an important lender, in particular an important lender to small and medium size enterprises, a bank with a very large and deep network and share of customers who hold current accounts but beyond. And we have started to get our arms in a more logical way around critical functions with a template. And I'm always saying when talking to banks as a joke, critical functions for the real economy are not equivalent to what do you consider critical for your bottom line. It might be something different. So it's really about financial stability and for the functioning for the economy. The G20 mandated the Financial Stability Board, or FSB, during the crisis to coordinate a global reform of the political framework. This culminated in 2011 with the so-called key attributes to effective resolution regimes for financial institutions. And among these attributes, so key requirements, is a guidance for resolution authorities to undertake a resolvability assessment. The FSB recommends in these key attributes, in German you would say paper is always patient, you can put out the attributes, now we have to put them into reality. The FSB recommends that these assessments should evaluate the feasibility of resolution strategies in light of the likely impact of a firm's failure on the financial system and the overall economy. So it's same words what we have within the BRRD. We are looking into financial stability and maintaining critical functions for the industry. The EU framework sets out the conditions, the objectives, and also the tools for resolution. And here I think it's very important to see that resolution is always an alternative to national insolvency regimes. And it is to apply it where, and only where, resolving a bank under this regime is in the so-called public interest. And this is either out of financial stability concern or because of the critical functions and interconnectedness of this institution for the economy. And the EU directives define it, considering that Europe is a colorful place or a place with countries of various size, always in relation to the member state or the union as a whole, which already gets you into one topic, what is critical and important for a very small member state might not be of any importance for a very large one. We have to adhere to proportionality here. While the FSB's focus has always been on so-called GSIBs, so globally systemically important banks, it's a group of roughly 30 institutions worldwide, the BRRD and the SRMR go beyond the global standard and set out detailed requirements for resolution authorities to carry out a resolvability assessment for a much broader set of banks within the union. Precisely, it's all banks beyond 30 billion balance sheet, and in any case, the 3 largest banks within a country, just to cover the most important ones. It's nearly identical to the coverage of the SSM in Frankfurt. So, our resolution also provides, which clearly the FSB could also only do with encourage countries to do, the BRRD and the SMR also provide powers for resolution authorities to remove impediments to resolvability, and you will find more about that when you want to read it in chapter 2 of the BRRD. I have to confess I read the legal text only if I need to look into it, but it's worth reading. In line with the FSB definition there, the SRMR describes that a bank is deemed resolvable if it is considered feasible and credible to either liquidate it or to resolve it while avoiding, to the maximum extent possible, significant adverse effects for financial systems, and with a view, again, to ensuring the continuity of its critical functions. To go into all of this, to prepare for all of this, the SRM, so national authorities together with the SRB, are responsible. If it comes to take a resolution decision, we consult with the national authorities, but the decision is finally taken by the board of the SRB. It gets a bit lonely at that point in time. So we are implementing all this, and we are, to simplify, defining a strategy for each bank whether insolvency or resolution would be the most suitable route to go, and its consequences behind this. The resolvability assessment we do is aimed at testing all the elements of this resolution strategy, such as business case analysis. Are assets, if you want to, separable? Can you split them? Does the bank have, and we are defining it, the required loss absorption capacity, the so-called MREL? Arrangements for operational financial continuity. I'll come to some of this later. So this is quite a long list of topics to be addressed. But let me also specify something which I think is sometimes getting forgotten. Having a resolution framework doesn't make resolution cost-free. When we talk about a resolution, we are just talking about a specific insolvency procedure. And you don't end in an insolvency procedure because you have ample equity. This is normally not the way. So the whole purpose of resolution is to try to manage this better, should it be required. However, while we spend a lot of time of planning, there are also lots of measures in place to ensure that resolution does not have to spring into action immediately. And I'm firmly convinced that good resolution planning will help avoid the one or the other resolution, because a bank is better prepared to address a crisis early on and not to wait for the resolution to come into action. This, so far, let's stop there for the framework, and hopefully I've clarified that we are not in a miraculous world where losses go away in resolution. They stay. So we can now go into a bit more the implementation of the framework, and this immediately naturally leads to MREL. Possibly it's the most known condition to make banks resolvable, and the most known is to have the needed funds to be able to absorb losses and to recapitalize, if there's a need, the bank out of its own means and not with recourse to taxpayers' money. The SRB has taken a very gradual, multi-year approach to MREL. You mentioned the fact that we need a transition from who holds instruments or who held instruments in the past, who should be a suitable investor. But it's also true, and I think there we have taken a gradual approach, that you can't build up the needed MREL in one go. The FSB has therefore taken a gradual approach. We have defined first a more, I would say, broad brush MREL. We have given banks up to 4 years to comply with this requirement. We are now in the process of defining, refining MREL. And of course, we are looking, and we have carefully watched over time all the work on the so-called BRRD2, so the work on refining the framework, which was ongoing and is now, I think, close to finish. It has to go through Parliament once more, but then it should be done. But to be clear, we have grounded our policy, and I've always said it's a bit like in traffic. If they talk about raising the speed limit, you are still not yet allowed to speed on a street. So you have to ground your policy on the currently applicable legal framework, but also we kept a bit an eye on the further development. So what did we do? This year, in 2018-19, we introduced a series of new features to strengthen banks' resolvability. Just to mention one, there were stricter eligibility criteria for capital instruments. So capital instruments in a subsidiary were not counting as eligible at the holding level, because you might not want to put the subsidiary into resolution, or you might not even be able to do so, but you need to focus on the holding company or the resolution unit. Increased requirements for subordination, the simple reason you mentioned it, no creditor worse off is very difficult to assess upfront, and subordination gives you a better chance to decide who has to be bailed in, and I think it's also more transparent. We have now binding MREL target, first time at individual level, so not just for the group, but for the main companies within a group. We are still in this process. We will have to introduce the upcoming rules. I think there's no contradiction to what we've done so far, which will have an increased minimum statutory requirement for subordination, and which will for the first time have a very solid framework for setting internal MREL. Now, I've always said the lack of sufficient MREL can be a very important barrier to executing a resolution strategy, but just Emre on its own is not enough to make a bank resolvable. And the findings from our first resolution planning cycles have revealed quite a number of areas, none of them really surprising, I think, for practitioners, as potential obstacles to resolution. Group structures, if you look at a group organigram and it takes you 5 minutes to figure out where's top, where's bottom, where's right, where's left, you probably have a group structure in front of you that in case of a crisis will cause you a headache. So group structures, clear group structures is clearly a topic. Management information systems is a topic which I'm increasingly losing patience with, but that doesn't solve the problem either. It is definitely a topic to work on. Operational continuity in resolution, because you want to keep up critical functions, so you need operational continuity despite resolution. Funding in resolution, so who provides the liquidity. And very simple, but probably in case of stress, really important communication. So how are you ensuring that you then really have a playbook to communicate? So just to go very shortly into some of them. Banks, particularly large cross-border ones, are characterized by very complex structures, which have historic reasons, tax reasons, all kinds of reasons, but definitely make the resolution complex issue. And as a resolution authority, therefore, we have to ensure that the legal structure and intergroup interconnections would not hinder but rather facilitate the execution of the preferred resolution strategy. This implies to identify and to remove sources of undue complexity. The funding structure is equally a key element, and it links back to MREL. Plans to meet MREL targets need to be developed by banks. This is the one area. But it should also be clearly developed how, in case of a crisis, would you downstream capital to the place where you need this capital, or upstream losses. And this has the key word for us here. We have borrowed it from our American friends, our American sports, is bail-in playbooks, to have bank-specific playbooks. And to be very frank, it is the duty of the banks to develop the playbook because they know their organization best. Our team is then scrutinizing and is considering whether this really works the way we consider it. But on top of this, and this is now going back to, what's the union's, united in diversity. So I think when I want to say it, I'm always struggling with this. But united in diversity also means we have 19 different member states. We are talking here about European law, European resolution framework, but our counterfactual, our basis is national insolvency systems. Our basis is national corporate law, national administrative law. So besides working on these very practical playbooks for bail-in particular, we, or in this case actually our national colleagues, are also working on national handbooks. How do you translate a decision taken in Brussels about a resolution case into national administrative law? And some people have heard me already saying, I've always said we were very lucky when we had the resolution of Banco Popular. It was a Spanish bank, and I think our Spanish colleagues at FROB would say they had unfortunately ample experience in how to enact a resolution decision. so that we could really do it overnight, because we could work very closely together to say, this is what we want to achieve, and our Spanish colleagues saying, and this is the instrument and how you have to word it to achieve it. And this is what, so in a nutshell, we are working on these handbooks per jurisdiction. When I say we, it's like in the family. We are just waiting for someone to do it. It's it's Banca d'Italia, it's the other national authorities, and the banks are working on the playbooks there. I mentioned, and I'm trying to shorten it a bit, I mentioned here management information systems. A key resolvability element will always be the ability of banks to deliver complete, accurate information in a timely fashion. It's as simple. This is the case in resolution planning. When we do MREL setting and the like, we need to have accurate data. We get them partially from the supervisory side, so SSM, but partially from the banks. And it is holding even more true in resolution, because then you have, if you're lucky, a weekend, or in our case, you have a night, and you need to know the data there. You could even go one step further. If you try to market a business and try to sell something, the times where you would not need a data room and due diligence are long gone. Today, you need to have all this available. And I'm always a bit stunned when I see people saying, yes, but it's so complicated. We are demanding from banks the so-called liability data template. We are now asking for it by end of March, data of year end. End of March is already 3 months. Last year, it took us till September. We asked for end of April, but it took us till September to have cleaned up these data templates in endless iterations, not with all banks, but with some. I don't think that this is cutting edge, and we need to get better there, or the banks need to get better on data. So this is clearly something which we need to do, and these data requirements are not just needed for resolution requirements. For all private transactions, they would need reliable data too. So last month we've published something, some might have seen it on our website, which might sound a bit weird, from the wrong side, taking it from the wrong side. We published a framework for valuation, which was not intended for banks or for resolution authorities, but it was intended for valuers. Background: in a resolution case, we need to have an independent valuation through a consulting or a dedicated firm for this, for the valuation for the bank. I wouldn't go into the details of all this. And we thought it was very helpful, and we've consulted intensively around this, to put up a framework which says, basically from the resolution authority perspective, what would we expect to be considered? We are not the valuer is independent, so it's a bit along the lines of comply or explain, so giving the framework for valuation. Now, this work, this is the one piece which we have done. It's on our website. Those people that know basically valuation rules will not find anything rocket science or surprising in, but I think it's putting it out for also having a level playing field. And we are at the same time now working together with the European Banking Authority, so EBA, who is working on a standard of data that banks need to have available for valuation. And here we've said we would join forces with EBA, so we are working together with them. This will be an EBA standard, which then will be mandatory for data availability and accuracy. So this is an area where definitely by far more work is needed. Operational continuity is an area we are working on. Operational continuity means, in particular, maintaining access to financial market infrastructures or intermediaries, and to just be able, in a resolution, to keep the bank going. As simple as this. It's a lot of hard work, it's a lot of negotiations to make contracts resolution proof, and it's just to be done. There is another topic which we are hard working on, but probably not yet at the end of what we want, definitely not where we want to be, liquidity in resolution. The starting point of liquidity in resolution is banks to be able, within their planning, to have liquidity safeguards. So not to say liquidity will always be there, like we did till 2007, but to be sure that in a period leading up to the failure of the bank is able to mobilize collateral, the bank is able to mobilize more liquidity, because the basic idea is always it is for the banks to make themselves resolvable. It's for the banks first to find a solution. One very important condition is that banks are able to monitor and to forecast their financial needs in resolution, and again, to mobilize and monitor available resources to meet the funding needs. The topic which then comes beyond is what, in resolution, how to ensure liquidity, because clearly a bail-in does not create liquidity. And on Monday morning, it's very likely that the other banks, other market participants are in a wait-and-see modus and are not immediately transacting with the bank. And it's also very likely that the bank's assets are to a large extent encumbered, so they don't have sufficient collateral. And this is why we are currently heavily working at the council level or with the member states to say we need to find additional solutions in this field. And I've always said, too much dislike of the central banks, and I can't foresee that we find any solution without the support of central banks as the ultimately able ones to provide liquidity. Let me stop here, and let me perhaps just say, how do we actually implement all of this, or how do we work? The first point here is clearly our internal resolution teams that engage with the banks. They are built, these teams, out of staff from Brussels, but also the national authorities. It's just once in a while easier to go across the street, or in this case, to go from Rome to Milan and not to fly in from Brussels. So this is the first thing. These teams are setting the work program, are setting the expectation. Then, second, the necessary information is provided or has to be provided by the banks. Our teams check whether the information is adequate, whether all this is working. And on that basis, the resolution teams will then assess, in light of the strategy designed for that bank, whether there are so-called impediments to resolvability and the impact of such impediments and the likelihood of their persistence over time. This is, as I said, a multi-year project. We are not immediately jumping on writing nasty letters from Brussels, but we are clearly monitoring that there needs to be progress, and we will intervene if progress is not forthcoming. But as said before, and I think it's really important, it's for the banks, and they are expected to play a very active role in this process of identifying, but in particular removing impediments. We are not the business consultants that go there, write the business plan, write the project plan for all of this. This is for the banks to do. During the assessment, the banks are asked to propose the measures, and it is only when all our action proves unsuccessful that we would use our authority to set in motion formal procedures to remove impediments. So far, to be clear, something that my Irish colleague at one point called an adult discussion had always been successful. So I think we are working in a world where we are setting the rules, but clearly the banks are very active in moving. So where do we stand? As I said, cautiously I would say it's still a long way to go, but I'm paid to be pessimistic and to err on the side of caution. But I think we can be definitely satisfied with the progress made in policy setting, as well as the progress as the engagement with the banks. But it just will take time. Starting with loss absorbing capacity, a lot of progress has been made. The G-SIBs, so the largest banks across the world, not just in Europe, now meet their FSB TLAC targets for 2019, and most of them also meet their target for 2020, which is a bit higher, and those that don't meet it have at least clear funding plans how to get there. For banks under our remit, we back-tested, like always when you back-test something, our latest MREL policy, and I'm not sure why MREL now results in bells ringing. And we found a shortfall of roughly 170 billion. Now, those that have in mind that last year we had a shortfall a bit below 150 billion, this might sound weird, but it needs to be considered that we have strengthened or tightened our requirements, but basically the future MREL generation has coped with this. And as always, the shortfall is not evenly spread. It's in some countries, but even there, not everywhere. The number is definitely not as large as some might have feared. I think when we started, I heard numbers from it's 1 trillion, it's basically the end of the civilized life. We are managing to get there. And as I said, we are giving banks time to reach this. But, of course, you need to move. And just to mention, I think any responsible bank management knew already roughly 2 to 3 years ago what was coming. The calculation of MREL is not rocket science, even if you don't get the last digit in. And therefore, I think I have always encouraged banks not to wait for SRB decisions, the sun was shining, the sun is shining, so let's get the house or the roof fixed. So it is an area where we need to work. Other areas where we, as I said, where we really have to make more progress is information in resolution. This is not for us to do. I know it's expensive, I know it takes time, but it has to happen. And clearly, in today's environment, we also need into the one or the other new challenges, one of them possibly called Brexit, depending on the funding structure. So with that, let me draw to a close. I will not touch on my most favorite topics, but I will at least mention them at the very end. I think we have come a long way, and we should, in all the list of what still needs to be done, not forget that banks today are far better capitalized, better quality capital than they were before the crisis, and we have addressed a lot of the interconnectedness and this. So we are not in the same spot, but there is still more to be done, and it's definitely not a short run, it's a marathon, and sometimes it might feel like an obstacle course, but it needs to be done. Yet, I think we are definitely here to see 2019 that we have now for all banks under our remit, except some very few exemptions, firm resolution plans with binding MREL targets, and in this case, really see the banks now step by step moving forward. They all got what one of my colleagues called greetings from Brussels at the beginning of the year. the others would call it a clear list of our priorities and expectations for 2019, and we are working on these now. And so I would say we are here for the long term. We are here to end the day where bailout happens in lack of alternatives. But there are also topics, I've mentioned a lot of topics banks have to work on, our colleagues, we have to work on. There are also other topics, and you mentioned some of them, like insolvency laws. It's beautiful to have 19 or even more than 19 different insolvency procedures. It makes life really colorful. It doesn't make it very efficient. So harmonizing insolvency rules so that a resolution has the same counterfactual, be it in Germany, be it in Italy, or be it in Malta, just to pick names, is an area. I've mentioned EDIS, the European Deposit Insurance System. I've been told by a German parliamentarian we should come back next time. He will be still there, hopefully, but please with a new name. And I promised we will come back, and if a new name solves the problem, then you would agree we come with a new name. We need a European solution here. We need to work further, which is in the Council, on the backstop to our fund and on the topic of liquidity. And I could go on with a lot of more topics, but I stop here. Thank you. Grazie.
I'd like to stress two. One, insolvency. Definitely, there is a huge case for harmonizing insolvency in Europe. I think here in Italy we take great advantage from that, and I would propose John as a new name for EDIS. What do you think?
I like the name
Carl. Perfect. Carl is a very good international name. Then we'll probably, the European Council will discuss a couple of years whether Carl with a K or with a C, probably.
If that helps, we take a seat.
But okay. Thank you so much. And we are fortunate to have Professor Elena Carletti, Scientific Director of the Florence School of Banking and Finance, and Professor Lorenzo Gai. I will give them the floor very shortly. I'll introduce myself. I am a journalist. My name is Federico Fubini. As a journalist, I'm not an economist. I'm not a law expert, nor am I a banker. But I do live at the intersection of finance, economics, politics, and what is most important for us is the public's perception. And as you were speaking, Dr. König, I was thinking back about the events of the last few years, because what happened is we have a very important principle here, and the principle is taxpayers do not have to take responsibility for mismanaged banks. And I think one of the most important missions of the EU today is to make this very important cultural change. Where does it come from? Well, of course, it comes from the crisis. We, as Italians, we used to have economic institutions that are very much informed by the crisis in the 30s. So the banking law in 1936, the very idea that no banks will be allowed to fail for the sake of political stability, and we know who was in the government office at the time. So it's a deep cultural change and a very important one. And of course I remember, as you say, 10 years later, 10 years ago, countries such as the Netherlands and Germany and others, and the US and the UK, but just to stay in the euro area, the Netherlands, 16% of GDP of public funds to support the banks. Germany, 9%. I'm going by IMF data. So there was a fair and understandable public reaction to using taxpayers' money for the sake of banks. And then Italy came along. Overall, I think Italy must have used about 1.2% of taxpayers' money to rescue banks. And what happened, I'll be very short because I don't want to waste our panelists' time, but what happened is that, to me as a journalist, I call it the beggar thy neighbor populism. Because, of course, the populist revolt in the country that spent a lot of money rescuing the banks was no more taxpayer money for the banks. And when BRRD happened, and then 4 banks were put in resolution in Italy, because essentially what would be the Italian edits could not be used to support those 4 banks, is that, paradoxically, the Italian populists got a lot of wind in their sails from the resolutions, because there was bailin, and especially there was a lot of instability in the system. So credit crunch and increased cost of financing and a general sense of tension. So the pushback from the populists in Italy would be no more banks would be allowed to fail, so no more bail-in. And in a way, that could put a lot of wind in the sails of populists, let's say, in the Netherlands. In a way, it's really in political terms, it looks very much like protectionism in the 30s. You try to protect your own political system, and what you do, you try to shift the problem onto another country, but by doing that, it's a lose-lose proposition. So this is why I believe it's so important to make this cultural change, to make it all together, to make it gradually, and talking about that, I think we are fortunate to have Professor Guy, and you have the floor.
Good afternoon, everybody. First, I'd like to thank Florence School of Banking and Finance, Fondazione CESIFIN, and Fondazione Firenze for the invitation. It's an honor to be here and to have the opportunity to participate and discuss this really interesting lecture that has a high importance for all of us. Due to the fact that I have not so much time to analyze the topic related to the General Recovery and Resolution Framework, and considering that Dr. König has just explained how the Single Resolution Board conceives and works on resolvability and given us an interesting assessment on the state of play and next steps, my speech will be focused on the Italian experience with different distressed banks in the last 5 years, as you can see on the first page of the paper that you have received. As Dr. König said during her lecture, the principles set out in the BRRD were meant to protect the taxpayers from bank losses. However, also new tools introduced by the new framework can produce a relevant social impact, given the types of securities in households' financial portfolios. Moreover, the effects can be worsened by the resolution principle have to apply retroactively to debt instruments already in circulation, rather than only to new issues. Besides, it is worth mentioning that these bonds were issued by banks also to satisfy the new liquidity ratios imposed by the Basel Committee, according to which banks have to plan their debts in order to better match the asset and liabilities maturities. Put this premise, my speech covers the conditions of applicability of the European framework and the level of flexibility of the EU rules, verifying if they are able to deal with different situations. In Italy, the application of the new framework raises specific challenges because of the large amount of subordinate debt held by households. Consob official data shows that over 20 billion euro of derivative bonds were placed by banks with retail customers in the period from July 2007 to June 2009. So a large part of the stock was built up in that period and then progressively increased until 2011, remaining around 30 billion euro until the end of 2015. The situation raises the issue of how to comply with the EU rules while at the same time managing their economic and social consequences. First, it needs to be emphasized that BRD doesn't represent the first law aimed at the reduction of state aids to save the banks in crisis. Since 2013, in fact, the communication from the European Commission on the application of state aid rules to support measures in favor of banks requires, as a condition for the approval of state aid for the recapitalization of banks, burden sharing for shareholders and holders of subordinate debt. For example, in Italy, in November 2015, before the entry into force of the BRD, the decision was taken to resolve Banca Marca, Banca Popolare dell'Etruria del Lazio, Cassa di Risparmio Ferrari e Carichieti, the four banks with a combined market share of 1% in Italy. The banks were resolved by transferring their healthy parts to bridge banks and by putting their troubled assets in a bad bank. The resolution plans provided for the support of the newly created resolution fund, whose interventions qualify as state aid under the EU state aid rules. These plans, which were approved by the European Commission, included the burden sharing for shareholders and subordinated bondholders. Nevertheless, since the application of the bailin was not yet in force, the resolution did not involve senior bondholders and depositors. Anyway, bailin is not applied in any condition of distressed banks to restructure and to return to viability. In fact, also after the introduction of the new framework, in order to start a resolution procedure under the EU rules, different conditions have to be respected. In particular, pursuant to Article 32 of the BRD, the resolution procedure may be initiated only when the following three conditions are met at the same time. The institution is failing or likely to fail. There's no reasonable prospect that any alternative private sector measure, including early intervention measures, will prevent its failure within a reasonable time frame, and a resolution action is necessary and proportionate in the public interest to attain one or more of the resolution objectives, and winding up of the institution under normal insolvency proceedings will not meet those resolution objectives to the same extent. In the case the European Central Bank doesn't declare that an institution is failing or likely to fail, a precautionary recapitalization procedure can be applicable. This is the case of the Italian bank Monte dei Paschi di Siena, not eligible for resolution, but for a precautionary recapitalization. In fact, the bank fulfilled the capital requirement under the base scenario of the stress test, but the results under the adverse scenario showed that a precautionary recapitalization was needed. The recapitalization plan with burden sharing for shareholders and subordinate debt holders was approved by the Commission under state aid rules, leading to the application of burden sharing. Like Monte dei Paschi di Siena, Banca Carige also didn't fulfill supervisory capital requirement, but it was not declared as failing or likely to fail. When Carige shareholders meeting didn't approve the private capital increase, the bank was then placed in special administration by the European Central Bank under its early intervention powers provided for under the BRD. Public funding for the reorganization of the bank was then provided by Decree Law 1/2019 and will have to be assessed by the European Commission under state aid rules. The question under consideration is whether the bank qualifies for precautionary recapitalization. The need for burden sharing could emerge in future. On the other hand, analyzing the Italian experience, two Veneto banks, Veneto Banca and Banca Popolare di Vicenza, was stated by the European Central Bank as failing or likely to fail. In these cases, a precautionary recapitalization procedure was not applicable. Nevertheless, the Single Resolution Board, which is entrusted with the task of assessing whether the third condition, the public interest condition, is met, deemed that the application of Italian procedures for an orderly resolution of banks would have been sufficient to attain the objectives of the BRRD. Thus, since the conditions for resolution action under EU rules were not fulfilled, the bailin procedure was avoided. State aid was granted to the two Veneto banks, around 5 billion euro, in order to facilitate their orderly liquidation and the sale of their worthy asset to Banca Intesa. Moreover, shareholders and subordinate debt holders were involved through burden sharing. Looking at the Italian experience with distressed banks in the recent past, the EU framework turned out to be rather flexible. However, some questions are arising. Firstly, is this flexibility a potential threat to the effectiveness of the EU rules, potentially violating the principle of level playing field? According to which specific conditions the Single Resolution Board decides that the public interest condition for the application of the EU resolution procedure is met or not? It is worth to underline that despite all banks, independently of their size, are asked to contribute to the Single Resolution Fund, only the significant banks can benefit from this, given the public interest in their resolution. Again, which are the boundaries for the application of state aid rules? For example, as to burden sharing, the Commission communication on state aid to banks contains some flexibility clauses. Notably, in points 19, burden sharing will be applied provided that financial stability is not put at risk, and 45, there may be exceptions to the application of burden sharing when its consequences will be disproportionate or would endanger financial stability. Moreover, the Court of Justice plays a crucial role since, through its interpretation of the new provisions in the light of the EU legal system, it can strengthen and refine the measures and tools designed by legislators. Regarding this topic, for the Italian case, just 3 days ago, the General Court of the European Union annulled the 2015 Commission's decision on state aid granted by Italy to the Banca Tercas. In 2014, the Interbank Deposit Protection Fund, FITD, which is financed by Italian banks, intervened to cover losses and support the acquisition of Banca Tercas by Banca Popolare di Bari. However, the European Commission considered that the intervention of the FITD amounted to the grant of state aid, arguing that although employing private resources, its interventions were elicited by public institutions. The European Commission judged that the intervention of the FITD as a state aid because the banks are forced by law to pay the money to the interbank fund. Therefore, the Commission ordered the recovery of the aid. If the funds, instead of being compulsorily paid by law, become voluntary, there's not longer any state intervention. Then the FITD collected additional funds from banks on a voluntary basis, so as to support the distressed bank while avoiding the application of state aid rules and burden sharing. The recent judgment of the European General Court is able to produce significant impacts and restores full functionality to the FITD. This is in fact a consortium governed by private law which acts in accordance with its statute on behalf of and in the interests of the members of the consortium. In force of the law, it must restore depositor in case of compulsory administrative liquidation of one of its members, but it can also intervene in advance on a voluntary basis and in accordance with its statute in order to prevent liquidation and potentially reducing the burdens that may result from the deposit guarantee. The 2015 decision of the European Commission interrupted these kinds of preventive intervention, implying, for other cases, the use of different instruments, such as the resolution of the 4 banks and the consequent burden sharing for shareholders and subordinate bondholders. In case of a preventive intervention of the FITD, the costs for both banks and private investors would have been probably lower. New claims for reimbursement of damages, both by savers and banks, will probably be addressed to the Commission in the near future. The second point, in order to exclude the need for further public support in the future, maybe the best tool is to prevent distresses with higher capital leverage requirements. In order to reduce the potential impact on retail senior bondholders and depositors, it's also important an adequate structure of the bank's liability. The challenge posed to resolution by the large amount of bank debt held by retail investors is acknowledged also by European financial authorities that amended BRD, introducing a new minimum requirement for own funds and eligible liability, MREL standards. I've just had the pleasure to hear Dr. König talking about this issue. Lastly, in Italy, the application of the new rules raises specific challenges because of the large amount of subordinate debt held by households. Moreover, those subordinate bonds by banks were sometimes placed by means of mis-selling practices. This challenge has been addressed since the very beginning by means of compensation tool aiming at remedying specific case of mis-selling to retail investors. However, while initially this was done under narrow conditions, the budget law for 2019 includes broader provisions. It had introduced the Fondo Indennizzo Risparmiatori, set up at the Ministry of Economy and Finance with a budget of 525 million euro a year until 2021. This last tool seems more similar to a blanket compensation for losses to bondholders and even to shareholders, contrasting the original aim to protect taxpayers, the first aim of the BRRD. Are the European authorities introducing specific rules in order to govern the topic of compensation tools? Thank you for your attention.
It's very late, and it's Friday afternoon. I decided to stand up, so maybe we don't fall asleep altogether. So first of all, let me thank the Fondazione, CESIFIN, and the Ente Cassa di Risparmio for organizing this event with us and for hosting us in this beautiful building. And last, but certainly not least, let me thank Dr. König for being with us today. I can assure you that we haven't hidden the Institute to you, and we would be very happy to have you actually at the Institute premises whenever you would like to come back. So let me also, before I go into some comments on your speech, let me also congratulate you and your institution for the remarkable progress that you have made since your inception. If you think where we were just a few years ago and where we are now, And yes, we miss Eddies or John or cars, or however we want to define it. But let's say that we have two pillars of the banking union up and running, they're real, they take decision, they intervene. And maybe it's also fair to say that relative to supervision, resolution is a completely new field that you started basically from scratch. So if you think where the starting point was, you relative to the SSM, and you see where you are, yes, maybe the journey is still long, maybe there are still open-end things to be done, and banks are not there yet, as you would wish them to be. But probably it's fair to say that the glass is certainly half full. And therefore, I think it's fair to congratulate you and your institution and your little staff that I think you have for what you have achieved. Having said that, as a role as discussant, let me raise three brief points. One of them is we talk very much about resolution as a way to reduce the involvement of taxpayer money. But the resolution should also have the objective of not to hurt the real economy, or at least try to sustain the real economy while preserving financial stability. So the first point I would like to tackle is whether we can assess whether resolution has actually achieved this goal. The second point I would like to raise is going back a little bit to what Professor Stanghellini was saying, which is MREL, that you also said how much banks need to issue and how they are going to issue this and what is the market for them up there. And finally, I would like a little bit talk about your issue of resolvability of groups, of big groups of banks, because we know on the one hand, we want to have internal market and we want to have cross-border consolidation and cross-border banking. But on the other hand, I think it's fair to say that we want groups to be simpler, and maybe there is a little bit the possibility of ring fencing and going back towards a little bit less integration of financial market, which I think is also a cost that has to be put into account once we look at how we make groups resolvable. Having said that, let me start with the first point, which is a resolution able to somehow ensure orderly resolution of failing banks with minimal cost for taxpayer and the real economy while preserving financial stability? So let me put a little bit my academic hat here, which is, do we have studies that actually can help us in answering this question? And it's not an easy question to ask, because it's not very easy to measure these objectives. It's easier to see that taxpayers have been less involved. That is easy to see. But it's very difficult to see what are the implications for the real economy from the resolution framework, apart from the populist view that you were talking about a little bit before, but this is less a slogan. Let's see whether indeed there has been something more concrete that we can measure. So there is a study by Thorsten Beck, who is a professor at City Business School in London, and co-authors, and they look at the application of bailin to the Banco Espírito Santo in Portugal. This is not in 2014, so let me stress this is a case outside of the BRD, precedes the BRD, so it's not part of the Single Resolution Board in any way, but it's the application of bailin, and it's the application of bailin to banks that had contributed to the Bank Resolution Fund in Portugal. So Banco Espírito Santo failed, and it failed not because it was in a crisis, the country, but it failed because the bank was giving loans to some firms that were related to the family owning the bank, but the firms were not creditworthy. So it failed just for pure idiosyncratic reason. The other banks were not affected by the crisis, and that I think is crucial to assess the effect of bail-in. And then Portuguese banks were asked to contribute to a bank resolution fund. Some banks contributed more than others. And then bail-in was applied, and these other banks that had contributed to the fund lost their contribution. So in a sense, they took a loss because there was the bail-in applied to this. Now the question is how these banks reacted. Did they keep their lending as before having the bail-in, or were they decreasing their lending because they had the loss induced by the resolution? And the study shows that banks that were more exposed to this bail-in because they had contributed more to the resolution fund, they decreased the credit supply by nearly 6%, which is not a small number. And they decreased this credit supply, in particular to larger firms and to riskier firms. Now, these firms that saw their loans cut, they went out and they found or tried to find alternative sources of financing. They found these sources, but at a higher cost. So there was a sort of loss there. But not only that, the study shows that the SMEs that saw their lending reduced from these banks that were hit by the bail-in, they cut their employment and their investments. And they cut investment by 2.3% and employment by 0.6%. Now, are these big numbers? Are these small numbers? What would have happened if we didn't have the application of bail-in? Maybe the bank would have been even more disorderly managed. Maybe the losses for the real economy would have been even higher. So it's difficult to take a stance as to whether resolution indeed, or the application of bail-in, it's fair to say, in this particular case, caused the damage to the real economy, and maybe it limited the damage that would have created otherwise. But I think it's interesting to see that there is a study that shows this, and is a little bit in line with a more general view of academia, that is that all this regulation that has been put in place, higher capital requirement, resolution, framework, and so on, somehow has become procyclical, meaning that banks increase capital by the leveraging, banks maybe are hit by bail-in and cut lending, so that there is a little bit this, at least in the shorter phase, in the transition phase as we have designed, that maybe these regulations may have actually a negative real economy effect, and I think this should not be forgotten. And maybe they are essential. I don't want to say that they shouldn't be there, but maybe is worth thinking about, seeing whether there are other ways in which the real economy can be preserved as much as possible. Let me now look to the second comment the second topic I would like to raise, which is the MREL requirement. I fully agree that MREL is essential for the application of a resolution, and I think one of the main problems, if we want to say, with the resolution was precisely the fact that bail-in was applied to existing securities. And we have seen the problem, particularly in this country, but let's not forget, this country is because in this country, subordinated instruments were in the hands of retail investors. This is very much an Italian peculiarity. In the other countries, this was not the case. But because of this, this country was particularly penalized, and as Mr. Fubini said before, we saw all this political reaction that is certainly not desirable in a way. Now, going forward, this should not be there anymore because banks should have these MREL liabilities, and therefore investors, first of all, should know that from now on the game is different. So, and this MREL instrument should not be anymore in the hands of retail investors. The problem is that banks have to issue this instrument, and as the SRB study that you mentioned showed, based on 2017 data, there is an estimated shortfall of 171 billion euro, and the gap for the subordinated instrument would amount at 67 billion euro. Now again, are these big numbers or small numbers, where we have to think who is the market that can actually buy those instruments, and who are the banks that are issuing these instruments. Because the large banks are sort of facilitated in that, because they have already the TLAC requirement. So the big banks are already issuing, for quite a while actually, this subordinated instrument, and they're tapping the market. And because they are big, they are GSIFIs, they can go and tap the market outside of Europe. So for example, Italian banks went to PIMCO, and PIMCO bought some instrument from Italian banks. But this market is not easily approachable for medium-sized banks that will probably still be subject to the subordination requirement of the MREL. So they will have to issue the same instrument as large banks, maybe in smaller quantities, but still the same instrument. And they may not have the same access to market. So then the question is, as you said, I think it's essential, but the question is, are we going to see a longer phase-in case these banks are unable to issue this instrument? Are we going to see a process of merger and acquisition, where these banks will sort of be acquired from the bigger banks, with the consequent problem maybe of reinventing the too big to fail problem a little bit? Or how are we going to do? And I think at the moment there is a lot of uncertainty, because as you say, and I agree, banks should have got prepared. They shouldn't have waited for the final digit of the MREL. But it's also fair to say that banks are really calculating the digit when they think about their funding strategies. So for them, the digit maybe are not trivial. But also I think that the SRB, and rightly so, has a lot of discretion in terms of senior exemption, in terms of asking for more subordinated requirement. So depending on what is this resolvability assessment that the SRB will be doing, the requirement for banks may vary quite significantly. So the question is, how do you see this MREL in combination with the potential difficulty of the medium-sized banks in particular to raise these funds, and whether this will lead to a different in-market structure or a different funding cost strategy for banks. And let me now come to the final point, which is the groups, international groups. So now in Europe, we have internet cross-border groups that all have the structure of the single point of entry. What does that mean? It means that there is, take banks like UniCredit and Intesa, just to make it easy. They have the single point of entry. That means that the holding company in Italy can issue MREL instrument. But then, because in particular UniCredit has this cross-border exposure, we'll have to pre-position MREL instrument in the subsidiary, in the significant subsidiary. Now, as we know, this requires a lot of coordination between host countries and home authorities. It means that the home authorities have to sort of be trusted that they would transfer this MREL instrument at the subsidiary level, and the host authority does not have to require too much of a prepositioning of internal MREL, because otherwise the benefit in a way of a diversification and possibility to move instrument within the groups is a bit lost. Second, as you said, the groups have to get easier. They have to get legal structure and interconnections that facilitate their resolvability. Now, I wonder to which extent these two elements, on the one side, the higher requirement of internal MREL, and on the other hand, the requirement to make the groups more resolvable, may lead groups to go for decentralized structure that at the end of the day end up in more fragmented financial markets. Because in a way, cross-border groups will have to construct many subholdings, if not going eventually to the multiple point of entry, with the clear loss of values that comes from losing integrated activities. So I'm just finishing with asking you, how do you see the cross-border groups going forward in terms of resolution structure?
Thank you, Professor Carletti. You raised a number of important points. We don't have much time, so I will move quickly to questions, starting with Dr. König. We have talked, of course, a lot about this Tercas ruling in Italy, but bygones are bygones. I think what is more interesting would be, and it would not be in your basket anyway, but it would be interesting, since that involves the role of the deposit insurance scheme at the national level, and we have interesting discussions about CARD at the European level. And so what does this ruling imply in terms of the role of possible deposit insurance scheme at the European level going forward?
As you rightly said, this is not my camp, but let me say, and just using the Tercas ruling probably as a hook to mention it. Sorry, I take it a bit closer. So, not any comment on the Tercas case or on this ruling. I have to confess, I've only read the press release. You should first read the whole text at least. The second, but it's a hook to remind us all of one topic, and it's come up, I think, also in the two speeches. When we look at the entire universe of failing banks, then the majority of the smaller banks would fall under the protection of a deposit guarantee system. And we all agree we need to put the deposit guarantee system on a European level to ensure that the home host bias is eased, if not going away, and for a number of other reasons. And in this context, I would find it extremely important to really spell out what should be the role of a deposit guarantee system. So is it just the pay box? So the bank fails, 7 days pass, and you get cash, a bit with the question, and what are you doing in between? Or should we not look more into what, for example, the American system does, to say there are alternative measures, like a transfer of customers to another bank and insolvency for the rest of this, and then to define, as we are still talking about insolvency, so we have something which has losses in, to say, and what should be in this system the role of the DGS. The Americans are simply saying least cost, meaning they have to choose the option that is hopefully the cheapest to go for the system. I think it should hopefully trigger this kind of debate within the next time, and I think there is room to improve and to harmonize our system.
My question for Professor Guy, you mentioned the case of burden sharing happening in Italy in 2015, but in fact we have not still seen a case of full bail-in, including not only shareholders and junior bondholders, but deposits up to 7%, 8% of liabilities. So do you ever expect to see as a plausible option, full bail-in happening in Italy?
For me, not. The bail-in has been in operation for more than three years. During this period in Europe, including Italy, there were several bank failures and rescue operations. European financial authorities have always preferred to avoid the application of the bail-in, favoring the use of burden sharing and state aid in different ways. The recent ruling of the EU Court also allows the use of the FITD voluntary intervention scheme. In light of this, I don't believe that the bail-in will be never applied to depositor, for instance, in Italy or elsewhere. It would have a disruptive effect. Let me make one final remark. I consider it a kind of fake news.
What?
Bail-in.
Fake news?
I disagree.
We have certainly not put down bail-in on a social network for the moment, so it doesn't fully qualify as fake news, at least under that respect. But Professor Carletti, you raised a different point on procyclicality. And of course, you said, of course, we don't have the counterfactual about the case of the Banco Spirito Santo. What strikes me, and I'd like you to elaborate a little bit on that, is what we had there was a case of, collective action and lack of coordination, because some of the banks got more involved and some of the banks opted to stay a little bit more out. And the banks that suffered and the customers that suffered were the banks that got more involved. So it is really a problem of collective action. So don't you think that the whole European effort, in fact, it's about addressing those problems of collective action and then, in that case, smoothing out procyclicality?
Well, it depends on what you mean really with collective action. I mean, these banks contributed more to the fund because they were bigger. So they had to contribute more. It was not their choice in a way to do it. So you could say that you would like to split it more, but it's fair to say that some banks will always necessarily have to contribute more. In a way, the larger banks should also be those that should be more able to absorb the losses. If they are not, then maybe we should rethink about the size of the banks in a way, because the large banks, they should have an advantage in that sense. I think the Spirito Santo is a particular case because the bail-in was most, I mean, at least the study concentrated on the bail-in imposed on other banks. It doesn't concentrate, it doesn't look at the bail-in imposed on creditors in terms of non-banks. And that, I think, it's an important distinction. So we don't have studies that look at what happens when you impose bail-in on creditors that are not banks. But in general, I think Dr. König can be correct if I'm wrong, but the tendency is not to have banks suffer very much from the application of bail-in. So all the MRL instrument should not be in the hands of retail and should not be in the hands of other banks, ideally. Then the question is who buys them. But
we were pretty quick in the first round of questions. I'll take my authority to ask one extra question only for Dr. König. But what we have seen, you have heard Professor Guy saying this is fake news, and Professor Caletti saying beware of procyclicality. There are a lot of misgivings about resolution. And what we see in the real world is that countries do go to great lengths to avoid it. I mean, certainly Italy with the two Venetian banks, they were extremely creative, but I can think of at least one case, now probably you'll disagree, but Nordelbe in Germany, it really came, Core Tier 1 was so low, and then there was a recap by the shareholders, but shareholders were all in the public sector. So there is a whole set of issues for the European Commission to assess whether that recap was done under market conditions or not. But the fact is, what we see around Europe is national authorities are really scared of facing a resolution. So how do you respond to that? Because I think, apart from Professor Guy, we all agree that bail-in is something to protect.
You probably preserved the most difficult question for me, but let me perhaps react, because you are right. In principle, MREL, and in TLAC it's explicitly spelled out, should not be held by other banks, because then you have exactly the interconnectedness. And I would disagree with the statement it should never ever be held by retail investors. I see a number of people here that probably qualify for retail investors, including you, that would be perfectly eligible by my standards because you exactly know what you do. It should not be, retail investors should not be taken for a ride. So I think I would call it that way. So, but to answer your question, I think forbearance or to hope for a better solution just around the corner is a tendency that we will always see in supervision in member states. I would not say because you want to avoid resolution for the loss, but because you always hope that there is a solution to come. The way the legal framework solved it was saying there is a double trigger. And the double trigger is failing or likely to fail has to be declared by the supervisor. They have all the information. They are the prime contact to the bank. But resolution authorities have the same trigger. And if they get the feeling the supervisor is just waiting too long, can declare the bank failing or likely to fail. I'm always saying this is a bit gifted, a poisoned gift, because clearly then the one who is basically second-hand knowledge or less in the day-to-day business would say, come on, enough is enough. But it is existing. The second part is something which we probably all need to learn. For me, for a bank, and you could probably say, looking at Banco Popular, you rightly said we are now, it's lawyer's delight. Every lawyer is suing us. But at the same time, when you go back into the year 2017 and you look into Spanish government bonds, or you look into Spanish economic data, you look at bank bonds development, you would have a very hard time to find the day or the week of the resolution. So we proved that with this decision, we maintained financial stability. We were lucky. We had a very potent buyer, and we could do it overnight, but it is a workable concept. And so I hope that we can overcome this feeling of you are now going into uncharted territory, and why not wait for another week? Because, to be very clear, and looking back with hindsight, well, what happens if you wait for another week? The liquidity situation gets more difficult. The bank's customers are normal, rational people. Those that can go out decide that it might be better to move your funds from A to B. So you end with a bank which has by far less potential to be resolved because there is less in business left. And at the end, well, if you try to sell something which is an NPL portfolio with attached business, it's more difficult than to sell a business portfolio with an NPL problem. So I think we're all aware it's an issue. It's always a judgment case, and you can't say in Germany you would say, because you're scared of your death, you now commit suicide. This is also not an option.
Thank you so much. There will be so many other questions to raise, but I think we are running a little bit late, and if there are no absolutely urgent questions, there is one. Yeah. Go ahead.
I'm sorry to
No.
The mic again. My remarks are drawn by your last words. The SRB was lucky in the Banco Popular case. I think that was probably the last case in history, or I may make it exist, in which there was a buyer for a failing bank. Because I think that resolution is easier as long as there are buyers. Italy has a long experience of liquidation done via a sale of assets in matter of days. During the weekend, we started from Banco Ambrosiano, and there have been many other cases. As long as there is a buyer, then resolution framework must simply adapt the possibility of selling part of liabilities. Then the question becomes who foots the bill for the untransferred liabilities that are not transferred. I think we are now facing a world in which there is no more buyer for traditional banks. So because banks are extremely difficult to be profitable because of capital requirements, UniCredit just issued a so-called Tier 3 instrument with 7.5 yield, which is a significant yield to be matched with via deposit and loans that are sometimes go sour. So if there are no buyers, I think we are left with only one option, which is the real bailin. A bailin which is, or a transfer of assets with contribution. I think that the Venetian Bank, Veneto Banca and Banca Popolare and Banca Popolare di Vicenza are just the first cases in which large banks do not find any possible buyer unless someone foots the bill, and in that case was state with almost 4 billion of taxpayers' money. And I think that this is the word that awaits for us. And in that word, we are not able to avoid difficult questions. So the first is, how much do you want to increase the capital requirements, or MREL, which is something that akin to capital requirements, which are costly. And you're right, many of us would subscribe a Tier 3 instrument with proper yield, but that is proper yield eats away the profit of the bank. And second, we will have to deal with retail investors probably with taxpayers' money, unless we are facing popular revolts, which do not like.
I fully agree that I would call it, coming with my background of my country, the good old times where a supervisor or, in this case, a resolution authority would have said, now it's your turn. This needs to be solved, and it's your turn. Next time it's your neighbor's turn. Those times are long gone. That does not work in today's environment. But I would still hope that for businesses that still have a franchise value, that have something, that you can find a buyer. You're right, we are living in a very low profitability business and quite demanding things. But this said, let's hope we get out of that at some point. But I would still hope that this is feasible, but it's definitely always only feasible for smaller banks, smaller portfolios. We have also to see, we are also living in a world where things go in fashion. When Banco Espírito Santo was resolved, everyone thought, bridge bank is a beautiful solution. You have solved the problem over the weekend, it's stabilized, only to find out if you then don't restructure, after 2 years, it hits you back. After Banco Popular, I got the feeling everyone thought sale of business solves all your problems. It won't. I agree with you, it doesn't solve all your problems. I would still hope for smaller banks, and we are putting quite some onus on our resolution plans to say, if you believe sale of business could be the option to go, what if you don't find a buyer? So then most likely open bank bail-in is the alternative to go for. But sale of business has never, ever been the solution and could never be the solution for the largest banks in a country, because there is just, when you talk about really a GSIP or even the layer below, those banks are by far too large for this. And there, bail-in and restructuring is the only option.
So we will go on and on, but I think we are running a little bit late, so I will invite Professor Renaud Deus to address the room. And I have to say, I apologize, I have to run to the train, otherwise my daughter will bail me in tonight if I don't come back early.
Well, be reassured, I don't want to be very long, but I wouldn't want this session to end without just a few remarks. The first one is, of course, to thank Dr. König for a masterful lecture. It's, I think, a wonderful illustration of something that is well known to lawyers, a corporation to which I belong, namely the fact that enacting the rule is not the end of a story. It's the beginning of it. And it's only by looking at what, among others, the implementing agencies do of that rules that you can find out what really has changed, can change, will change. And the story you've told us is also a very important reminder, important for all those who want to make sense of European integration, namely the importance of the time variable. I do remember, actually listening to you, I was reminded of a conversation I had on financial integration in Europe with somebody who is very missed, Tommaso Padoa-Schioppa. And this was more than 30 years ago, and his remark was, well, yes, financial integration is indeed an important objective for Europe, but to tell you the truth, I would already be happy if we had a single banking market in my own country, Italy. Now, looking back, of course, you can say that so much has happened, because even a lay person like me can see that that market has changed dramatically. But listening to you, we also invited to think of the future, and you wonderfully illustrated that, yes, much has been done, but much more remains to be done for the journey to be completed. Enough for today, certainly, and I really want to thank you and the speakers in this session for this discussion. I also want to thank our partners, CESIFIN and the Fondazione Cassa di Risparmio, for their ceaseless support in our activities. I think that today's session illustrates, well, the fact that because things are changing, there is also huge need for training. And when I say this, I mean it. I think it's our role as institutions of higher education to think of what our contribution may be in the training of current professionals and future professionals to the changing European scene. We're privileged here in Florence because we have a wonderful environment to bring both first-class professionals and new generations of learners. I hope that among the things you will bring home, Dr. König, is also the memory of the fact that this is a focal point where you will always find interest for the patient activities of European regulators, and I very much hope that we will have the pleasure of having you back in a not too distant future. Having said this, I conclude, and I invite you to a refreshment which will be served next door. Thank you very much and have a nice evening.